Good afternoon and welcome to SuperReturn International 2016 for this, our first live stream discussion. And as you can see, I'm joined by a very esteemed panel of some of the key thought leaders in the private equity world. So I'll just go along the line and introduce you all, if that's okay, gentlemen. So on my far right there, we have Stefan Zuschke, Managing Partner of BC Partners. Welcome. Next to him, David Blood, Co-founder and Senior Partner of Generation Investment Management. Welcome. Next to him is his co-founder of that company, Al Gore, of course, former Vice President as well. Welcome. Thank you for joining us. And then on my right here, we have Thomas von Koch, Partner and CEO of EQT Partners. Welcome. And then over here on my left, on my far left, we have John Hill, the Vice Chairman and MD of First Reserve. Welcome. And next to me here, last but by no means least, of course, Alan MacDonell, MD of Teacher Retirement System of Texas. Thank you all so much for joining us. Now, this morning at this conference, we've heard lots of talk about the general global economic environment and some of the challenges your industry face in what is quite a tricky time. So I'm going to set off with that, if that's okay. And Stefan, just ask you, what would you say are the key challenges at the moment and how can your industry mitigate those, if you like?
I mean, key challenges, I think, it's not a dramatic change. I mean, the key challenge, it's getting more transparent, it's getting more competitive, there's more money in the market, we all know that. At the same time, I'm absolutely convinced that private equity, and that's our business here, will get increasing opportunities. I think the acceptance of private equity, especially in continental Europe, which is still a bit, of a weak spot here, I'm sure Thomas agrees on that, still has a lot of catch-up potential. So I think there are enough opportunities. Name of the game is, from our perspective, on one hand, I think loyal and long-term relationship to our LPs. They make our business work. Secondly, being close to the market, pick your battles, and in the end, I think what differentiates us is really, how to create value with your portfolio companies. I think that's the name of the game. And as long as you are able to, pick attractive assets, have a clear value creation roadmap on what to do with your business, I think there are plenty of opportunities.
You talked there about this being a relationship business, and that's something that you two, I know, Al and David, are very involved with your sort of impact investing, if you like. Tell me about that and why you think that is somewhere that we need to be going in terms of future.
Go ahead.
Well, I think first of all, I'm not sure we would think of it as impact investing. We would probably categorize it as investing.
Okay.
But clearly our thinking around sustainability is a framework to set an investment process and to identify businesses that we might like to invest in. I think the reason why we talk about sustainability, though, is that it does provide that framework and it does provide a lens to help us identify the businesses that we want to own and help grow over the course of the next number of years.
And we think there is a tremendous set of opportunities as the world confronts a challenge in adjusting to a much lower carbon economy to help solve the climate crisis, as it adjusts to much higher levels of efficiency with the Internet of Things, the digitized economy, and the chance to become much more efficient at managing electrons and British thermal units, just as we managed digits in the past. And so we use sustainability along with the traditional tools to try to find great investable opportunities and give our clients the best returns we can.
How much are LPs embracing that? Is it realistically something that people are, very interested in at this moment?
Absolutely, and the interest is growing steadily. I would say there was even a more recent surge of interest following the Paris Agreement in December, when virtually every nation in the world adopted a new roadmap to phase out all greenhouse gas emissions in the second half of this century. But when we started more than 10 years ago, there was some interest then, and it's grown steadily. It's now growing quite rapidly.
And I guess the results speak for themselves. That's what you talked about a bit this morning in your presentation, was that can't be argued with.
Well, we don't ballyhoo our results, but I'm going to knock on wood. We've gotten good reviews from our clients, and we try to prove the business case that fully integrating sustainability into mainstream asset management is best practice, and we hope to continue to have a chance to prove that case.
Thomas, I can see you nodding there, because this is something that I know you believe in wholeheartedly as well, isn't it?
Very much so. No, we're pretty simple investors. We invest with a trend, and sustainability is clearly here to stay and will be for the coming 100 years at least. And we have made a lot of fantastic acquisitions actually within the sustainability field. And I think sustainability, it's quite simple, it's just good business. It's just good business. It's not any bogus, humbo jumbo people dressed in green. This is just good business. So we are putting a lot of efforts behind it.
John, do you agree? Is this where things are going to be in the next short term, or is that a longer term view, do you think?
I think it's a longer term view. Actually, First Reserve invests across the value chain. We're in solar, we're in wind. We think there's a place for that in our spectrum. But we actually think that as Mark Twain once said, the death of fossil fuels has been over-exaggerated, slightly exaggerated. Look, the world is growing with another 1.9 billion people over the next 25 years. They're going to need a lot of oil and gas, a lot of fossil fuels to support their increases in their standard of living, increases in their health indices, increases in their educational levels. There's just no other, and at least within the next 10 to 15 years, the alternatives cannot fill that whole gap that's going to be needed to raise the standard of living around the world. So we don't look at the price of oil as one of our big challenges. Our challenges are really to find solutions for our investors, and those solutions generally are higher return type solutions. It's in solutions for parts of the world that don't have energy, so we're active globally to provide that. But we also think it's going to be a tougher environment. First of all, economic growth has slowed for the world. The top line growth of industries is slowed. So we're looking at a world now where you're really going to have to be able to find the best companies to make those kinds of returns that our investors need, not just every company. Plus, with the decline of what's happened in capital markets with high yield bonds, less and less support in the debt markets for our private equity. There's going to be more equity involvement in this game. That puts more pressure on finding the very best companies with the best managements. But it also means financial engineering cannot be a part of these future returns. It's got to be growing good companies with good managements, meeting real consumer needs.
Alan, you're representing a huge LP. You're listening to John there. What do you think? Do you think that's what LPs are looking for?
We had a comment on that. I represent an organization that works on managing the retirement benefits for approximately 1.4 million Texans. My sole mandate, our main goal is really to make sure that we're looking for the best possible returning asset, regardless of if it's sustainable investment, ESG investment, or what. My main mandate is really to make sure that at the end of the day, they have enough money to pay milk, sugar, buy milk, sugar, eggs, butter, et cetera, to cover daily living. This is directionally accurate, but the primary income or the bulk of our beneficiaries probably earn about $40,000 a year on average. So we have a very strong mission to make sure that at the end of the day, we can cover, or we can make sure that they have enough retirement income coming in to cover their life.
And do you think relationships between GPs and LPs are changing, and you're able to have more influence and say?
Being the sole LP among four GPs, I think there is greater dialogue between interest between the GPs and the LPs, and to the extent that we all get on the same page, alignment of interest in terms, fees, et cetera. I think it can only make the private equity universe and private equity mandate better for everyone at the end of the day.
I actually think the growth of co-investment from our LPs, including the Texas system, is a big indicator there of how that relationship is growing closer and closer. It's a way to find more, let's say, special solutions for special circumstances. It's a way to deal with fees. So I think co-investment is one of the major trends in this industry. It's a way for our LPs to lower costs, to get better exposure, get a better return, diversify their risk. So I think it is getting closer.
Do you agree the model's evolving, if you like?
Yeah. No, please.
I think I fully agree on that, and I think there are two ways of looking at it. I mean, on one hand, there are certain LPs which compete with us, which is clearly also one trend. So we clearly prefer partnership. I mean, you see us working on assets, we work together, we, pick the LPs as co-investors who also bring something to the table, like, access to certain markets. So I think this is clearly something which also, I think is a long-term relationship with our LPs, offering co-investments, sitting in the same boat. Fully agree.
So who are the winners and the losers at the moment, would you say, and who's coming out on top in terms of their strategy?
I'm not sure you can frame it in terms of winners and losers. I think what I think we're all acknowledging is we are operating in a low interest rate environment, a low return environment, but yet our clients and the asset owners have very significant obligations. And so we need to find ways to work to help them meet their obligations. What's also clear is maybe the ways that we've done business in the past will need to evolve. So, for example, co-investment is a very good example. Maybe transparency is a further good example. Possibly the types of structures that we offer. The notion that you have a 5-year investment period and a 5-year liquidation period may not make sense in every circumstance, and we need to have a conversation around that. And then lastly is value for money. If we as an industry cannot consistently deliver value for money for our clients, particularly in a low interest rate environment, we're going to have to change our model, because there's going to clearly be higher demand and expectation and scrutiny to demonstrate that what you're delivering for a client is worthwhile.
Alan talked there, Al, about how at the end of the day the return is what matters to his people, but do you believe that you are seeing more investors that are genuinely interested in becoming more responsible socially, environmentally?
There have always been investors who have been willing to look for managers that will be completely consistent with their values, even if that shaves a bit off the maximum return they might expect to get somewhere else. And for quite a long time, that was the reputation that managers who focused on higher values, including sustainability, had. What Generation represents is a new approach that really focuses first and foremost on getting the best returns for clients and doing it in a way that integrates sustainability. The earlier models left 99% of the investor community less interested in going that route. It became a niche of roughly 1% or so. And the early models had checklists or negative screening approaches. We won't invest in this, or this. And then when those returns were less than interesting to most, a new model emerged called positive screening. We'll just pick the best in each of these categories. And even though we respect those models, they were seen as having a trade-off. But the full integration of sustainability in every aspect of the investing process can, if done correctly, actually produce higher returns, not lower returns. And that means that it's of interest not just to that 1% in the community that was willing to trade value for values, but to the entire investment community. And that's our mission, to prove the business case that that's how it should be done.
That chimes with you, I think, Thomas, because that's where EQT like to come from too.
Yeah. No, really, as we see it, and I don't know if you others see it, when we meet the LPs now, they say we want 10%, and what we can give you is certainty of funds for a longer period, and then you help us achieve that kind of goal. So I think the roles are blurring somewhat. This raise money every 4th year is somewhat disappearing because you strike longer relationships with LPs, and since we have a fairly broad product range, we can mix and match a little bit to satisfy their needs. So that's a trend we clearly see. I don't know what you see in the market.
Yeah, I think we do. We clearly see that. I'd like to expand a little bit on the sustainability issue to make it a broader environmental question. A lot of our investors, very sophisticated, in fact, I think they're probably the smartest people I know, they a lot of them are concerned about the environment in a very real way. So they expect us as a company to operate with the highest of environmental standards. We were the first, I think, fossil fuel investor to sign the UN PRI Accords. We believe in that. And we didn't just do this, though, in response to investor concern about us following the best protocols, if you can, in all of our business practices. You cannot earn a high return in our business. We cannot deliver the returns unless we, in fact, do honor those protocols. One blowout of a well can kill an investment, okay? So it's good business today. And you can only generate, we think, these good returns if you really are operating with a very high degree of environmental concern and protection and protocol.
So just changing the subject slightly now, we talked there about the model changing and sort of long-termism. Is that something that is becoming increasingly important in an environment that is evolving quite rapidly, but you need to look longer term, do you think, as well?
That's for sure. What we see with LPs is that, at least up until December, I said, don't send me the money back, right? So don't send us the money back, and they kept on getting money all the time. So the LPs now are, they have the obligations you have, and they say, I have a 30-year obligation. If I get 8-10%, can you provide me that kind of product? And we provide then, on our hand, to commit on a longer term. So clearly I see a more vivid or lively dialogue, and you say, the 220 and the 25% gross IRR, that kind of debate is some sort of becoming, changed. When LPs try to deploy money and take down the fees, but in return, deploy money for a longer time, for sure.
Is that something that you see?
Yeah, I would say if I would rather earn 20% over 3 years or 15% over 10 years, I would go for the 15% over 10 years. I think it provides a better model for our beneficiaries, for our fund, for our process. Again, I'm not going to give up, 20% over 3 years, but having the alternative, I'd rather have that consistent cash flow or return for the next 10 years as opposed to a short-term orientation. I think private equity gives us that model to do.
That's a more prudent objective too, I think, a more realistic and prudent objective.
How do you think that technology is going to affect all of these factors, because it's so fast moving in something to embrace? Stefan, I'm going to talk to you about that. What do you think is going to happen in your industry embracing that, and how disruptive it could be?
Yeah, I mean, first of all, we are not tech investors, but certainly, technology is something which impacts each and every portfolio. So clearly, digital and digitalization is, a buzzword, and we need to take care of it. So, it can be a threat, it can be disruptive, but it can also be an opportunity. And that's why, for example, we just added, one guy to our ops team who comes from the digital world, and he helps us assessing the opportunities. One hand, how to deal with your portfolio, how to prepare your portfolio for certain disruptions, but also how to take advantage of it and, add value to the portfolio. And I think that's exactly the point which John made. The time of, financial engineering and hoping on bullish capital markets, it's over. So we need to add value to our portfolio. And I think, the technological part is clearly one important route to get there.
And it's also looking at technology disrupting all the industries that you invest in. There was a lot of conversation this morning about the automotive industry, say, and what impact that's going to have. Do you see that sort of as a red flag, if you like, at the moment for lots of investors?
Well, I think there are there are four big trends threatening to disrupt the auto industry as we have known it. The shift to electric vehicles, which may be slowed down somewhat with very low oil prices, but will not likely be slowed down a lot. The shift toward partially or fully self-driving automobiles, which is a huge revolution. We're already seeing some partially self-driving cars on the road. Within 4, 5, 6 years, I think it'll be a very big trend. And then lightweighting with carbon fiber and other much lower weight materials. And then finally, the sharing economy with new models like Uber and Lyft and some of the models where you just drive a car and leave it somewhere and somebody else picks it up. And with the millennial generation, that trend is likely to pick up a lot of steam. I'm not smart enough to analyze how all four of those trends interact with one another, but I'm pretty sure it means we're in for revolutionary change in the auto industry.
And that's just one industry.
And that's only one industry, that's correct.
In terms of the disruption technology could cause, also, I suppose those millennials might expect to be able to invest in a different way, and that's something else that's come up as a topic, is this sort of idea of retailization of your industry and making it more accessible. Do you think that's a realistic prospect, David, and is that something you're aware of?
Well, I knew the question was coming, and I've actually thought about it, but it's really tricky, actually, and already, so in the hedge fund industry, there is a retailization. There's an ability to, through ETFs and other things, to try to get that investment exposure. And you would think that will also be true in private equity, one way, shape, or form. I think and no question, technology will change the way people invest. First of all, as institutional investors, it will certainly enhance our ability to process data and to think about ways to enhance our knowledge, if you will. But ultimately, the decision to invest and allocate capital is really hard. It's really tricky, and I think we underestimate how hard it is. And to basically say to someone, a millennial, that, well, here's you now have access to all these different things, that's great, and I'm all for access, but I'm not sure it's necessarily going to help her or him develop a investment portfolio that will ultimately be sound and robust in the years ahead. So we've got to wonder about what the tools ultimately give us in the end.
Alan, the expertise has got to remain for the sake of your consumers.
Yeah, I mean, in terms of turning private equity into a retail product, which I think is your question, these are 5, 10, sometimes 15-year, 20-year horizons. You can't really turn that into a retail product and make it a short-term vehicle. It'd be the classic investor mistake. Buying low, selling high. You don't know how a company's going to perform literally until 3-5 years from now, and then that's part of a pool of capital, and you can't be coming in and out of tailoring a product into a retail component that you can buy and sell every day. It's just, I don't think it's going to make the democratization process of giving the retail investor that opportunity. I think it's going to, again, I think it'll be the classic investor mistake. There's a lot more nuance that goes behind underwriting a manager, underwriting a private equity fund, really understanding that long-term process that unfortunately just you can't pick up that easily.
I would actually not want to see a big development from retail investors. To make a private investment is a serious asset allocation decision. It needs to be made by fairly sophisticated people. More importantly, most retail investors don't have the luxury of having a big piece of their portfolio even in an illiquid position. They really need liquidity. And look, private equity, some days there's liquidity, like the last couple of years. The next 2 or 3 years, there's not going to be liquidity. Yeah, that's right. So I think it would be a mistake to have this industry sort of see that coming and try to develop it. I think it really belongs more in the institutional and investment professional class.
That's how things will adapt, rather than it being an extreme change.
Right.
Well, if I may, I mean, I'm looking at it from a slightly different perspective. I fully agree. Retail investors need to understand that it's not a liquid asset. But I think from our end, Thomas, I think we're a bit in the same camp, and that's different, in continental Europe to US or UK. In our countries, private equity is still somewhat, negatively seen. So, having retail investors, selling it broader, I think, helps us creating acceptance, seeing and showing to people that we really add value to companies. So, prove to these people that we are able to develop a business, to really add value, to grow businesses. And I think from that perspective, it's a different point of view, but I think from that perspective, we are very open to that. And I would really, like to see, more of these retail investors, investing into private equity.
That's something you've talked about in the past, reputation, if you like, isn't it?
For sure. And we call it license to operate. Yeah. And we're just certain, if we're not accepted in Germany by the politicians or by the media, we cannot do business there. Yeah. It's gone so far in Sweden, so I actually go to the politicians and say, you know what, you tell me, do we have a license to operate here? Because if you say we don't, we leave. It's gone that far. You know, the bashing of our industry in Europe has been that bad, despite creating so much wealth, not only for ourselves but for society when it comes to employment. So actually, we're flipping it coin around and saying, dear politician, I met actually some politicians from another country in Europe have said, you know, please come to us. And I say, why should we? You bash us in the press every day. So why should we come to your country? We cannot conduct our business if you bash us. So we need, I totally subscribe to you, but that's also up on our shoulders to be transparent, communicate, talk to all journalists calling, open a Komodo. We have no secrets. We do mistakes like everybody else, but we do actually also create wealth. So, but that's the industry phenomenon that people are in a cave and some of our competitors, they lift the phones, tell the journalists we're private, don't you know, and hang up the phone. That kind of behavior is a no-no. Exactly. Then our whole industry is going to be hit. But that was a long answer to say, I'm in your camp.
Reputation counts. I do think in the U.S. we have an issue in private equity. We tried to distinguish ourselves from the hedge fund people who, you know, it's a different group, different game. They have a different reputation, and we try to tell people, you know, we're here for the long term, building good companies, creating jobs, and so forth. So we do have to worry about reputation as well.
It's quite a hard line to tread that. You know, the traditional Joe on the street wouldn't see private equity as a touchy-feely kind of thing. Is that something you see in terms of reputation? Is it important?
Oh yes, of course. And I think you're probably right about the man in the street. But as someone who came only 15 years ago to the business world, I can tell you that it's been one of the most interesting and enjoyable experiences I've had in my life. And David and I are privileged to work with partners and a team of men and women who have such high values. And I don't want to just brag on generation. I just want to tell you that whatever the impression is of private equity by the person on the street, the reality, at least in our firm, and I know in many others as well, something very different and something I have really been honored to be a part of.
It's good to hear. Is that something you would agree with, Stefan? It's, you know, you said there it's important, and you think it's important to the general public that's...
Oh yeah, absolutely. I mean, you know, we live on our reputation. I mean, in order to buy a business, you need a seller. And, you know, a seller needs to agree that, you know, we are ready to develop the business. So we live on our reputation. So no doubt about that. Yes.
But I think that's what John said earlier, is that we do need to, with low interest rates, financial engineering is over. That's actually quite a good thing, because that has been very unhelpful from a reputational perspective, and actually licensed to operate in what is good to be doing. Now what we really need to be focused on is how do we help entrepreneurs or business leaders build great long-term sustainable businesses. And that can be really interesting, it can be very fulfilling, and it can be very important to LPs' results as well as, importantly, economies.
Now, it would be
in the long term, the long-term period that private equity has, or even some long-only investors who give you long term, it's a huge advantage. It's a huge investment advantage.
Now, obviously the geopolitical situation has been high on the agenda. There's so much instability, and it would be remiss of me as a Brit not to ask about Brexit and what you all make of that too. So Stefan, do you want to lead off?
Good. Go ahead.
Thank you.
Go for that. What's yours?
I don't think it will happen. I can't imagine it. You know, I can't imagine it happening. I mean, of course, you know, we have issues. We have geopolitical problems. We have economic problems in Europe. We are faced with the immigration issue. But whatever it is, I just don't believe that a country on its own, you know, can solve it on its own. I mean, you need a certain cooperation. You need support. You need, you know, a balance of power. So I just cannot imagine it happen. If it happens, I think it will be clearly disruptive to our industry, and it will have a huge shift within our industry, probably away from UK.
What would it mean to the US? What would they make of it, do you think, in the US?
Well, I'm British too. Well, look, President Obama has come out very clearly and said he thinks that's a really bad idea, and he thinks the referendum itself is probably unhelpful. It's going to happen, and we have to hope that the Prime Minister and those who think it's important, and we completely agree with your assessment, it's important to stay part of Europe, make the case very compellingly. And it now requires a very thoughtful and compelling case to be made, and the good news is it can be made, but it has to be made.
I know you called yourself a recovering politician earlier, but from a political perspective, how tricky a situation is this now for David Cameron?
Well, he created the situation in part, but I'll just simply say that I think there are larger values and interests at stake here. As a citizen of the United States, I know that a strong and fully integrated European Union is incredibly important for the stability of the global community, the commitment of the global community to democratic values and standards for human rights. And the future of the EU in turn is much brighter if the United Kingdom remains a part of it. Unlike David, I'm not a dual citizen, I'm just a US citizen, and I'm reluctant to state such strong views on a subject that the UK voters will be addressing, but I do think it's so important that I'm not going to hesitate to answer your question. I really hope that the UK stays in the European Union.
Thomas is somebody who's in Europe, fully immersed. What's your point of view?
No, I think since I'm a Swede and the Brits and the Swedes have to share the same views in the EU, pro-trade, etc. For Sweden, it would be a disaster. I think for the UK, it's going to be much bigger of an issue than the no side realizes. I think it would be a major mistake, and it could be the first of the dominoes tipping European collaboration.
Indeed, one of your key co-speakers this morning talked about Italy being potentially the next sort of country, rather than Greece even, that could be potentially. So it's a tricky, volatile situation.
Yeah, well, look, I'm an energy guy, so I don't understand all the issues that are bringing this vote to a head in the UK. I think there may be some similarities to what's going on in the US, but not totally. So I wouldn't even try to handicap that. All I know is that if it were to happen, I probably wouldn't be looking for investments in the British North Sea or looking at a British windmill farm. I might be thinking about moving my colleagues in London to Houston or New York, because I think it would not, from what I've read and understood and hearing from more intelligent people on our panel on that issue, it would probably not be a good thing for the UK economically. Makes it an uninteresting place for us to invest.
So that's the immediate future for the UK in terms of votes in June, but what about the next 12 months for this industry? What will we be sat here talking about in 12 months' time? John, do you want to kick that off? What do you think?
See, I think in 12 months' time we may be talking about what happened to the UK vote. I think we may be talking about what does it mean to have Donald Trump as president. I hope not, okay? But God, that would be not a great conversation to be having.
Alan, what do you think?
No, I agree. I think markets and investors hate uncertainty and instability, and to the extent that the Brexit and the U.S. political situation are still, I mean, obviously we'll have better clarity, but leading up to that, I think it will still, create moments of volatility or erratic behavior.
Could be a tumultuous year.
Yeah. But I think once, again, not knowing who's going to be elected, I think that in and of itself won't solve, once you know who's in, then you still have to figure out, well, how's that going to impact, the markets, this industry, that industry, this country, that country. So I think there's still, I think 12 months from now, we'll still be talking about, whatever happens to Britain, in the summer, and the U.S., in November. But that's what makes investing,
Exciting
interesting.
place to be. Chaps, any ideas about the next 12 months?
Well, I think you asked some really great questions in the beginning, and I think we can go back to them to say that we as investors have to navigate these environments, and next year will be tricky also, and the year after that will be tricky, and so investment frameworks will continue to be critical. And the other important observation of the panel is really that we need to think differently about how we're working with the LP community, and that we need to think differently about how we're adding value to businesses, and we think that's a good thing.
So evolution.
Exactly.
I am hesitant to predict, but I expect that 12 months from now, one of the topics we'll be discussing is how much progress we've made in reducing global warming pollution, how the price of renewable electricity from photovoltaics and wind and the reduction in demand from higher levels of efficiency and demand response approaches will turn the curve of global warming pollution downward. I'm optimistic about that, and I hope that within 12 months we'll see a general increase in optimism about that.
A fantastically optimistic note to end on. Thank you so much, gentlemen, for joining us here at SuperReturn International, and thank you to our audience who've joined us for this, our first live stream event. Please do return to SuperReturn Live for more unique insights, but from all of us for now, goodbye.